Hello George, it's great to see you all. This is a very important video. I'm going to look at adjustments, and from the adjustments you're going to complete financial statements. This is a typical exam question. You do the adjustments, you skip the steps in between, and you draw up the financial statements. So just very quickly, you are given a pre-adjusted trial balance. The adjustments which we're doing at year end, you will do as workings. Then what will happen is, from the workings, you're going to complete financial statements. So a statement of profit or loss and other comprehensive income, as well as statement of financial position, an income statement, and a balance sheet. So the examiner is going to skip a few steps in the process, but going to give you the adjustments, and then you're going to have to draw up the financial statements with the numbers that truly reflect the financial result and position of the business. Just quickly, hopefully you've watched the previous two videos on adjustments. We're going to be introducing accounts like this at the end of the financial year when we do the adjustments. Owing expenses, accrued expenses, and that is a current liability. For example, a wage or the telephone bill. We know that we've incurred the expense, but it has not yet been paid. We need to make an adjustment for owing expenses, and accrued expenses is a liability, a current liability. Accrued income, for example, we've earned interest on a fixed deposit, but we haven't yet received it. We must show that we are owed income, accrued income, and accrued income is an asset. A prepaid expense, we might have paid an expense which relates to next year, and we need to take that expense out of the expense account by debiting an account called prepaid expense, and we will credit the relevant expense account. Prepaid expenses, current asset. So there we got two items that will fall underneath current assets in the statement of financial position. There's income received in advance. A person could have paid us in advance. For example, if someone is renting office space and they've paid us for 13 months when we should have we have only earned income when we're reporting for 12 months. So we need to an adjustment. Income received in advance, that is a current liability. An allowance, provision for doubtful debts. You will see we will do an adjustment like that. The allowance is a decrease in accounts receivable, and what we will do, in line with the textbook that the NMU students are using, we will debit bad debts and credit the allowance account. We will look at an example. Okay, we're familiar with depreciation. Depreciation is done at the end of the financial year to truly reflect the correct book value of our non-current assets in the statement of financial position. If we have consumable stores on hand, for example stationery that hasn't been used at the end of the period, it doesn't fit the definition of an expense because the stationery needs to have been used to show it as an expense. When we buy stationery, we debit stationery increase in expense, but at the end of the year we make an adjustment to show the correct expense the correct stationery expense. You will see a bit about that. And the stationery or the consumable items that weren't used, we debit an account called consumable stores on hand, which is going to go under current assets. Then also in this example here, we're going to do a bad debt that is recovered, and you will see we'll debit bank and credit bad debts recovered, and that is income. And then once again, all these assets, these new asset accounts, increase in assets get debited, increase in income. If we make an adjustment and it so happens that the income has increased, credit all the expenses that need to be adjusted. It might increase in expense or decrease in expense. That income received in advance is a liability. So you need to know your rules and you need to apply your rules to understand. So let's get going. Now in this example, or in an exam example, you will get a pre-adjusted trial balance and you will get additional information which shows you which adjustments you need to make. So I'll run through this very quickly, but I'm going to do each one individually. On the 28th of February 2025, that's our year end, Calibre Education knows that 1,250 is due for the telephone account, but it hasn't been paid. So you've got an expense that the telephone has been used, but it's not showing in our books. We are going to have to make an adjustment there. And in this case, the expense is telephone, debit telephone, credit, accrued expenses. Calibre Education took out a fixed deposit with Investec Bank, earned interest, and the interest is at 10% per annum. So you take 10% of the fixed deposit and you see if the balance in the interest account is correct. A debtor was declared insolvent. This amount of money must be written off. Number 3, there's always a bad debt just before an allowance for doubtful debts is made, and it needs to be adjusted to 4% of accounts receivable. That bad debt must be taken off the accounts receivable amount before you calculate the 4%. Okay, the student that went insolvent came into some money, so we're going to record the fact that we received some money from an insolvent debtor. At the year end, there was 1,100 Rand worth of stationery. That's consumable stores on hand. We need to do depreciation. Luckily, in this example, it's on the straight line method. 20% per annum on vehicles and 10% on equipment. It was discovered that 1,500 worth of commission received relates to March next year. So in the commission account, there's actually 1,500 commission that shouldn't be shown in the current year. So we need to make an adjustment there. Then there's an advertising contract, and you will see that there's 4 months of the 6-month contract which is outside the current financial year. So these are the transactions we're going to do, and we're going to put them on the face of the statements. The statement of comprehensive income and the statement of financial position. And the way to go about a question like this, I'm going to show you as we go along. Now, we are given, it says here, the pre-adjusted trial balance on the last day of the financial year. So before that additional information has been taken into account, you've got these numbers in the pre-adjusted trial balance. Now I've gone and highlighted in red from looking at that additional information, all these accounts here in red. Well, not the fixed deposit amount, it won't change, but the interest on the fixed deposit will change. And the bank balance, allowance for doubtful debts, So this is information that has been given to us before the adjustments. I've put in here, because I saw the additional information, there will be consumable stores on hand. It will be debited because it's an asset. There is owing income. It will be debited, but we'll see how much by in a moment. Accrued expenses is a liability, and therefore it has a credit balance. Income received in advance is a liability. Prepaid expenses is an asset. So I've had a look at the additional information. You guys have practiced it so much, you know that these accounts will come up. We just don't have the numbers for them yet until we've done the adjustments. But you're given a pre-adjusted trial balance, and it has all these numbers. And these numbers are the starting points when you do the adjustments. Say accounts receivable before the adjustments was 15,000. Accumulated depreciation already has a balance. I know we've had these non-current assets for a year because it was 20% on vehicles and 10% on equipment. You do the maths and those are the balances for accumulated depreciation. But my point is, you get given a pre-adjusted trial balance and then you do the adjustments. This is the statement of financial position where we're looking at owner's accounts, assets, and liabilities. You're also given, I couldn't fit this onto one page, so I've divided the real accounts and the nominal accounts. This interest income, we're going to check if it is correct. There's depreciation, we don't know it yet. That's an in account expense. The telephone account is going to change. Stationery is going to change. Advertising, bad debts, commission income, bad debts recovered. Those numbers are all going to change. In this example here, it's the perpetual inventory system. We got sales and cost of sales, which we will use to calculate the gross profit. So these are our income and expense accounts, and we're going to check the numbers with the adjustment information. Right, in the exam, you are given a statement of profit or loss and other comprehensive income of a business for the year ended. You will not be given the headings, but I'm telling you now, if you don't know the little headings, you're going to be stuck. So in this statement, we're going to have all the income and expense accounts, and the purpose of it is to calculate a profit or a loss. So just by knowing that, you can list how do you calculate your income, or how do you calculate your gross profit. You start with sales, cost of sales, you're going to get a gross profit. Then you're going to have other income, interest on fixed deposit, maybe commission received, bad debts recovered. Then you're going to get gross income. Then you're going to say less your operating expenses, and you're going to get a profit or loss. But the starting point here is, in this document, the statement of profit or loss and other comprehensive income, you have your income and your expense accounts. If you do forget the headings, you're still going to pick up lots of marks, right, from the income and expense accounts. You're given a statement of financial position, and in here, once again, you're going to have to know what goes in here. And you got assets equals owner's equity plus liabilities. That is the accounting equation. Easy. Non-current assets, current assets. Owner's equity, capital. Your liabilities, non-current and current. Owner's equity will consist of a few things. The opening balance for capital, less drawings, plus the profit. But you need to know what goes into the statement of financial position. Easy. Real accounts with the new numbers. Your B accounts. Assets, owner's accounts, and liabilities. It's your accounting equation. So now I'm going to work through all these numbers and my starting point. You will develop your own methods along the way. I'll show you what I just did in this video. What I did was I'm starting with putting information on I'm just going to call it the income statement, right? Income minus expenses. I'm putting in there the gross profit, which is sales minus cost of sales. I've highlighted in yellow what I'm working on. So if I go to the income statement, and now I've gone and filled in a template, because I know what goes into an income statement. Sales less cost of sales is gross profit. So I took those numbers, which didn't change, and I put it in, right? Sales less cost of sales is the gross profit. Then I don't know the correct figures yet for commission income and bad debts recovered, but we will see. And then you add them together and you get the gross income. So you got add other income less other expenses. And yeah, there's also the way I'm going to do it according to how you're doing it in your textbook. Other income, I'm going to also put in here, there's going to be the interest on the fixed deposit, interest earned. Normally interest is shown separately at the bottom, either interest earned or the interest expense, but we're just going to put the interest on the fixed deposit under other income. Right, so what I did here, first thing was I said sales minus cost of sales, and it gives me the gross profit. Now I went and filled out the template. There's a heading above here. This is the statement of financial position, and I've gone and put in there the non-current assets. I saw there was vehicles and equipment. There is a financial asset. It has its own section, the fixed deposit, and then there are current assets. And the current assets, there was a trading inventory account, accounts receivable, right? Accounts receivable less allowance for doubtful debts will give you the accounts receivable amount. There's prepaid expense adjustment that's going to happen, which is an asset. There it goes under current assets. Accrued income, current asset. Consumable stores on hand, current assets. Then you're going to total up your assets, because it's non-current plus the financial plus the current assets going to give me the total assets. Total assets is equal to equity plus liabilities. Equity, the capital account, we're going to have a few numbers, and then we got the current liabilities, accrued expenses, and income received in advance in the example that I'm doing. You could have accounts payable, but I don't have it in this example. So this is a statement of financial position, and now I'm filling in the items from the pre-adjusted trial balance as I complete these statements. So I started with a blank template, and now I'm just putting in the items. Now we go on to the first transaction. It says on the 28th of February 2025, Calibu Education knows that 1,250 is due for the telephone account. As this is the monthly payment as per the contract, this amount will only be paid in March. We have used the telephone. It's only going to be paid in March. We've used it in February. So we've incurred the expense, but we still owe it. We need to do the adjustment. So one of the accounts will be accrued expenses. The other account is telephone. Right, I'm trying to remember the numbers, because when we do the workings, telephone is 13,750. Remember that. So now we got The telephone account, I'm just going to put a T for telephone. These are T accounts. It had a balance of 13,750. It needs to increase by another 1,250. And this one here is accrued expenses. I'm using T accounts to do the workings. This number I got off the pre-adjusted trial balance. Telephone has a debit balance because it is an expense. I go and debit telephone with 1,250 because we used the telephone in February. And I credit accrued expenses, which is a liability, with 1,250. Now what I go and do is I go and find these accounts on the two statements where you've been completing the templates on your answer booklet, and we put that information in already. The telephone account, now you put next to telephone in brackets. This amount here, the 13,750, came off the pre-adjusted trial balance. The 1,250 is the adjustment. Now I haven't gone and totaled it up yet because who knows, maybe there's another transaction that relates to telephone, so I'll do that at the end. But this is where you're scoring your marks. One for putting the balance from the pre-adjusted trial balance plus the adjustment amount. This is in the statement of profit and loss because you've got income and you've got expenses. So there's the telephone amounts, the balance from the pre-adjusted trial balance, and the 1,250, the adjustment. So this is what you're doing. In brackets next to the account, you are writing the amounts that are going to give you the final telephone amount. Then the other side of the entry, remember we went in with this adjustment, credited accrued expenses. I know accrued expenses is a current liability, that's why I've put it underneath here. In brackets you write 1,250. Excuse me. And we go on to the next one. Number 2. Calibre Education took out the fixed deposit with Investec Bank on the 1st of March 2024. That's a year ago, because we're now at the 28th of February 2025. Interest was calculated at 10% per annum on the fixed deposit. We had it for a year, 10% per annum. So the information I need, I go to the pre-adjusted trial balance and I check. The fixed deposit with Investec Bank was 100,000. What we've done is we've earned 10% on the fixed deposit for the year, which is 10,000 Rand. You can punch that into your calculator. So you will see I've highlighted here accrued income. We've earned interest but not yet received it. But it's a little bit more tricky than that. 10% of 100,000 is 10,000. We're owing income. Income is owed to us from the interest on fixed deposit. I'll show you why in a moment. Now if I go to the nominal account section, there's an interest income account and it has a balance of 9,000. But this amount here should be 10,000. So I do workings. You can develop your own methods. The important thing is that you get the correct numbers on the financial statements. So this is the transaction, and I've got 3 accounts here. The fixed deposit, and in there was 100,000. You can go check the pre-adjusted trial balance. Then you've got the interest income is I think what they called the account, but basically the interest on the fixed deposit was sitting at 9,000. But the interest earned on the fixed deposit is 10% of 100,000, which is equal to 10,000. The amount in this account here should be 10,000. So the adjustment will be credit the interest account with 1,000 and debit accrued income, which is an asset, with 1,000. Now we take our workings and we put the information onto the statements. Just note the fixed deposit amount didn't change. We only needed that 100,000 Rand number to calculate what the interest should be, what should be showing in the interest account. So the adjustment was 1,000, the interest increased, and accrued income was debited with 1,000. So we go to our statements on the answer booklet, in the answer booklet, and the interest income was 9,000, but it should be 10,000. So we put in another 1,000. There's a mark and a mark. This amount, 9,000, came off the pre-adjusted trial balance, and the 1,000 is a result of the adjustment that we just made. So we're completing this, and there was the telephone account that we've done already. So there's the interest income, and note I put it under other income, which is not exactly correct, because normally interest income is going to be in its own section. Interest is always shown separately, but for this examination, the interest income you can put under other income. Right, the accrued income, the owing interest on the fixed deposit, accrued income, falls under current assets, and it's 1,000. There's no opening balance for accrued income, because this is only done at the end of the financial year, and in the new year it's reversed. So every single end of financial year, the balance is 0 for accrued income until we do the adjustment. Right, next one. A debtor was declared insolvent. This debt of 5,000 must be written off. The accounts involved will be accounts receivable. Remember, it has a balance of 15,000. And bad debts during the year, there's already been write-offs, but now at year end there's another 5,000 Rand write-off. So at the moment that bad debts number is not correct. So let's see what we need to do. So what we got here is two accounts. The one is bad debts. Sure. Now I can't remember the bad debts amount, but it had a balance already. And now it's going to increase by 5,000. And the accounts receivable, which had a balance of 15,000, is now going to decrease by 5,000 because of this bad debt. So the adjustment is debit bad debts with the 5,000 and credit accounts receivable with the 5,000. So there we go. Bad debts did have a balance of 1,350. Now it has increased by another 5,000 because of this student going insolvent. If you need a break, eat a potato. Right, the accounts receivable, it had a balance of 15,000. Now because of this bad debt, it has decreased by 5,000. Right, now this is important. There's an allowance for doubtful debts. We know that all our debtors are not going to pay us, so we make an allowance for doubtful debts, and they adjust it to 4% of accounts receivable. Now this is important. because I haven't gone through this with you guys in too much detail. The allowance for doubtful debts from the previous year, there was a balance of 300. Now they're saying make an adjustment of 4% of accounts receivable. So remember, there was another bad debt that you must take off. So 15,000 minus 5,000 times by 4% is going to give you a number for allowance for doubtful debts. Allowance for doubtful debts is a decrease in the value of accounts receivable, by the way. It's a decrease in assets. Allowance for doubtful debts. Now they're saying the amount for allowance for doubtful debts must be calculated as 4% of accounts receivable. Remember, there's a balance there already in the account of 300. Bad debts is going to change again, because you will see with the adjustments which accounts get debited and credited, and I'm just going to go according to how your textbook operates with this adjustment, the NMU students. So there's a balance 1350. Right, an allowance for doubtful debts must be adjusted to 4% of accounts receivable. Okay, I can remember the numbers. You will have to check on your paper the pre-adjusted trial balance. So 4% times by the accounts receivable balance was 15,000, but now there was a bad debt, the varsity college student. Don't forget to take off the bad debt in the adjustments. The other bad debts have been dealt with regard to the balance of the bad debts. But in the adjustment, you take off that bad debt that happened in number 3. Now, that is equal to 400. Punch it into your calculator. 4% of 10,000, 15,000 minus 5,000 is equal to 400. But the allowance account has a balance of 300 according to the pre-adjusted trial balance. So this allowance account, provision for bad debts allowance account, which is a decrease in assets, must be increased by another 100 to make it 400. And the account that your textbook debits is bad debts, and that increased by another 100. So this is your adjustment from this transaction, and it will look like this. That 1350 in bad debts was the amount from the pre-adjusted trial balance. The 5,000 was the varsity college student that went insolvent, and now there's an extra 100 because the provision for doubtful debts was made bigger by 100. Remember, you can go back in the video and have a look at explanations anytime you can move back. Right, so there's our bad debts now. Has a amount from the pre-adjusted trial balance. It had a student that went insolvent, or debtor that went insolvent, and then there was still an adjustment to the provision for doubtful debts, and that increased by 100 to make that allowance go from 300 to 400. The adjustment needed to be 100. Then in the allowance for doubtful debts, there we go, goes under current assets. It's actually decreasing the accounts receivable amount, because accounts receivable is going to be whatever in accounts receivable less the allowance and then you're going to get the correct amount for our debtors, accounts receivable, and the asset will be truly reflected in the statement of financial position after the adjustments. Let's move on. Right, number 5, easy one. This honest varsity student came into some money and paid us 1,000 Rand. Now what will happen is our bank balance will increase because we're receiving cash from the student, and when we receive income or cash from a debtor who has already been written off, we open up an account called bad debts recovered, and bad debts recovered is an increase in income, so it will be credited, and we know the amount is 1,000. So this bad debts recovered is income, and it would go into the income statement under other income. So let's just quickly have a look. I do everyone in the T accounts. We received 1,000 Rand. Our bank balance increased by 1,000. There was an opening balance. And what did we receive? Bad debts recovered, which is an increase in income, and it's 1,000. So they're the workings. Now you need to put this information onto the financial statements. So bad debts recovered now is 1,000. Okay, that interest income was from the fixed deposit. The new transaction is bad debts recovered, falls under other income, 1,000. Our bank balance, I took that bank balance off the pre-adjusted trial balance plus the 1,000 that we have just received now from the bad debts recovered. Right, number 6. At the end of the year, there was stationery unused, consumable stores on hand. We need to show that as an asset and make the expense account smaller because that stationery wasn't used. So we have an account consumable stores on hand from the I just put it onto the pre-adjusted trial balance because I know that it's going to be an adjustment. And the stationery, remember that 4514. Now we need to do the workings, and we've got your stationery 4514 from the pre-adjusted trial balance, stationery, and the contra account is consumable stores on hand, which is an asset, and the amount that was left over is 1,100. We're going to show that as an asset. Now this is important. I've had a question, how do you know when to make something bigger or smaller? At the moment, the stationery account, which is an expense, is reflecting 4514. When we buy the stationery, we debit the stationery account, increase in expense. But at the end of the year, the expense is not 4514 because 1,100 of the stationery was still left over, and we can show it as an asset in consumable stores on hand. So if this had a debit balance, the stationery, and I go and credit it, it's going to make the stationery amount smaller. Right, because we didn't actually use 1,100 worth of stationery. So the expense is actually 4514 minus 1,100 will give us the expense of the stationery that we used, because we counted what was left, 1,100 worth of stationery. Hope that makes sense. In this case here, we're taking off the 1,100 because the 1,100 is not an expense. The stationery hasn't been used. The rest of the stationery has. And the difference between the debit side and the credit side will be the correct amount for stationery. There we go. So stationery is 4514 minus 1100. You see how we are accumulating marks here as we're completing this document. Plenty. Nice. So there it is, stationery with the adjustment. And now we have an account under current assets, consumable stores on hand, 1100. Keep going. You can stop the video and take a break. Not too many more to do. Right, number 7, we've done a lot of depreciation, so I can go through this quite quickly. But the depreciation is 10% per annum, nice, on a straight line basis for equipment, and 20% per annum on the straight line basis for vehicles. So this accumulated balance here for these two non-current assets, it's already 30,000 and 1,700, but you still need to do this adjustment. So we've had this vehicle or these vehicles and this equipment for a period of time, and it is already depreciation on the non-current assets, but we still need to do for the current year. So this year, this is going to increase and that's going to increase when we do the adjustment for depreciation. Let's say, for example, this was year 1 and now we still need to do year 2. Depreciation is an expense and it falls in the income statement expenses, but at the moment we don't have a number for the depreciation account, but after the adjustment we will. So here we go. Quickly, depreciation is an expense. We've got here accumulated depreciation. Let's do on equipment, and we've got accumulated depreciation on vehicles. And I know accumulated depreciation on equipment had a balance of 1,700. It's on the credit side because it's a decrease in the book value, or decrease in the value of equipment and vehicles. That's what accumulated depreciation is. Decrease in assets. Vehicles was 30,000, right? Now we're going to do depreciation for the year end, at year end, and we got here 1,700, which is 10%. If you go and have a look, of 17,000, because the book value or the historical cost price of the equipment was 17,000. 10% of 17,000 is 1,700. Debit depreciation, and once again we're going to credit accumulated depreciation, let's say for year 2 of equipment. Then we got 20%, and the cost price of vehicles is 150,000. So depreciation once again will be debited, and the accumulated depreciation on vehicles will be credited. So there's the depreciation movement and the accumulated depreciation movement for the current year. So you do those calculations, easy. And now you see the depreciation for the current year is 30,000 plus 1,700. Depreciation starts off every year with a 0 balance. The accumulated depreciation has a running balance. Now what I've done here is, and I'd like you to do this, because normally your PPE will appear in a note to the financial statements. So let me show you. What we want to show over here is the book value of the non-current assets. So the book value is the historical cost price, 150,000. You get that off the pre-adjusted trial balance, minus the pre-adjusted trial balance accumulated depreciation, minus this adjustment. So let's call that year 1 and year 2. And the same with equipment. Equipment was 17,000 off the pre-adjusted trial balance, the cost price of equipment, minus the accumulated depreciation of 1,700 off the pre-adjusted trial balance, that's where I got that number from, minus the adjustment now at year end. So in here, you're going to have, in this case, vehicles 150,000 minus 30,000 minus 30,000 is 90,000, right? In this example, and for what we need for exam purposes, is the face of the statement, but often these calculations are done in notes, but we're not doing the notes. Just a little bit of background there. But let's move on. Right, number 8. Excellent. It was discovered that 1,500 of commission relates to March next year. This is income received in advance. You guys know that by now. 1,500. So income received in advance is going to be affected, and commission income is going to be affected. Remember, you're given the pre-adjusted trial balance with all these numbers. But these accounts here, like say for example depreciation and bad debt recovered, I've put in. So there is commission that relates to a future period. At the moment there's 37,000 in the commission income account, but that's not accurate. You need to take the adjustment into account. So it was discovered that 1,500 relates to March. So we've got here commission income, and it had a balance of 37,000. But this is not a true reflection of the income that we've earned for the period. 1,500 needs to be taken out because it relates to next year. And the other account will be income received in advance, which is a liability. So we debited commission income and we credit income received in advance. Now we're going to put this information onto the statements. There's commission income. It was made smaller, 37,000 minus 1,500. And income received in advance, which is a current liability, is 1,500. Cruising. Right, last one, last adjustment. A 1,206th month advertising contract was entered into and was paid for on the 1st of January. When is our year end? The 28th of February. So we've got a 6-month contract and 2 months should reflect in the advertising account, but at the moment 6 months reflect in the advertising account. So there's a prepaid expense. Now we need to calculate the amounts. And what has been prepaid? Advertising. Included in here is an expense for advertising, and part of the contract is outside of the current year. 1,200, 6-month contract divided by 6 is equal to 200. When was this paid? On the 1st of January 2005. Where are we? The 28th of February 2025. So we should only be paying for January and February. That's the expense that has been incurred until our financial year end. This is a 6-month contract, so March, April, May, and June are examples here. It's been prepaid, the expense, for 4 months. So 200 multiplied by 4 is equal to 800. And the entry will look like this. Prepaid expense, this year was advertising, the expense. I can't remember the advertising balance, we will check now. But 800, that is incorrect. 800 needs to be taken out. Why? because it is a prepaid expense, and a prepaid expense is an asset. And this year, the expense has actually decreased. That's why we credited to truly reflect the advertising expense for the current financial year. So advertising, there it was, 2950 off the pre-adjusted trial balance, minus the adjustment, the 800 that was prepaid. And prepaid expenses now under current assets is 800. Let's move on. Now, we finished all the additional information and the statement is on the table. We've got here commission income. I've gone and calculated all the brackets. Bad debts recovered. Interest income, 10,000. I'm adding them up. Depreciation, 31,700. Telephone, 15,000. Wages did not have a... It was on the pre-adjusted trial balance. There it is, 7,000, but there were no adjustments to wages. Stationery, there's the correct expense for stationery. Remember that was left over. Consumable stores on hand. Advertising, we've taken out the 800 that relates to next year. And now we've got the correct advertising expense for the current year. There's bad debts. Bad debts was the pre-adjusted trial balance balance, plus the student that was written off, plus the allowance adjustment of 100. Comes to 6450. So now you add these all up. Soon we're going to calculate the profit. Right, I've taken the statement of financial position. We haven't dealt yet with the capital, owner's equity. What is the owner worth? It's capital contribution less drawings. So let's have a look. Just going to do there. That came off the pre-adjusted trial balance minus the drawings. We still need to calculate the actual net profit to get that amount. Then what I went and did was I just said 150 minus 60,000 is 90,000. 1,700 minus 1,700 minus 700 is 13,600. That is the book value of the non-current assets. You had a fixed deposit, there it is, financial asset. You had current assets, bank changed because of the bad debt recovered. Accounts receivable changed because there was another bad debt of 5,000. The allowance for doubtful debtors was 4% of 10,000, which is 400, and we made the adjustment. This is how I've recorded it, yeah. Accounts receivable now is 10,000, but a true reflection of accounts receivable will take off, that's why I put that in brackets there, the 400. So the allowance for doubtful debts is a decrease in the value of accounts receivable. I could have gone and put it in over there, but I did it separately. Prepaid expenses, which is a current asset, 800. Accrued income, current asset, 1,000. Consumable stores on hand, 1,100. So this is what we're working to here. There's the income received in advance, accrued expenses for current liabilities. So I've taken all the workings and I've put them on here. Like I said, you will develop your own methods. It's important. The more you practice, you might leave out the T accounts and straight away put the information here if you understand it really well. It's up to you. But it's important to, in brackets here, you've got to put in how you calculated these highlighted yellow amounts to score points. Right, so we still need to calculate the net profit, and that amount is going to be taken from the statement of comprehensive income. Let's move on. So the gross profit, I just said sales minus cost of sales. Add other income, add those three together, you get the other income. The gross income is the gross profit plus the other income, gives you the gross income, less the expenses. You add up all the expenses and you put them in, and then your gross income less your other expenses. In this case here, we've made a profit of 42290 and 56 cents. Who's entitled to the profit? The owner. So the owner needs to get this amount, this profit, added to the capital amount, and there it is. So we got here, in order to get this capital amount, we've got the capital amount of 363,575.09 less the drawings plus the net profit gives the capital amount. Then if you want, you can go and add this up and see, because assets is equal to owner's equity plus liabilities. Look at that. 405,121.93, 405,121.93. So from the adjustments now, you drew up these statements and look at all the marks. Got to show those. Okay. Then you can put the numbers in there. And this here balances. I hope that helped you. This is the way questions are asked in exams. You're given a pre-adjusted trial balance with additional information, and they say complete the statements, the financial statements, the statement of comprehensive income and the statement of financial position. The statement of comprehensive income, income and expenses, and the statement of financial position right in front of you, assets equals owner's equity plus liabilities. There are some additional questions on Funda for NMU students. Check it out. Right, it was great to meet the George people. All the best for your exams. You've got this. Cheers.